Good morning, good morning, good morning, everyone. My name is Don Daniel, founder of Pill Method International, a better way to eliminate debt. And today we're going to understand where this whole idea of 30-year mortgages actually came from. We're going to be doing some historical stuff right now. So today, right now, I'm going to put on I'm going to put up a link right now so that you can study this with me. And Kurt Nugent, in the private chat, I got a link there. All right. It is to a historical article on mortgages. We want to share that with everyone so everyone can take a look at this. Plus, we're going to put it on the screen when I have opportunity. So let me go ahead and post this link so everybody can start reading it. All right. So pin the link. All right, and let me copy it. Okay, copy the link and put it at the top of the page. There we go. All right, and add the link. There we go. All right, folks. So here's what you want. This thing is powerful. It's a very good read for the whole thing, but there are certain parts of it about mortgages that you deserve to know. You deserve to know this. And so if you want to see some of these examples that we're going to be talking about today, ladies and gentlemen, you want to go to YouTube on a secondary device and search Pill Method, because you are going to want to see these examples. If you have a question or comment, come to the stage, raise your hand, and I'll bring you up if you are listening on Clubhouse, but you also want to see these examples, okay? You want to go to, I'm going to put it in the chat, okay? ice10k.com, ice10k.com. Okay. And on there, you'll see, let's see, on there, boom, boom, boom. We changed it up. We changed it up a little bit so that you'll be able to find the links to watch us on YouTube or Facebook. All right. So you'll be able to find us on YouTube or Facebook. The links are going to be there. Just click on, Ice 10K Live. So you'll be able to see us live. So find the live button or just go to YouTube and search for the live. Now, when you download this article, all right, I'm going to show you where to go. All right. So I've got some certain parts that are I've got highlighted, and I'm going to show you where to go on this thing. But first of all, I need you to go to YouTube or Facebook right now so that you can see what I'm getting ready to put on the screen. All right, getting ready to put something on the screen right now. So we're going to show some $200,000 houses. Okay, some $200,000 houses. All right, the price. Oh, okay. All right. So my man tells me that that's blank. So let me paste this in here. There you go. Boom. There you are. Sorry about that. All right, there you got the link now, Kurt. And so Kurt Nugent is our producer. He makes sure that everybody gets to see everything and gets to hear me online. Okay, so he's got that. Roger Farmer from that's watching us. He's watching us on YouTube. We got Strategic Secrets saying good morning. He's here watching us on YouTube, and I have several people here that are on Clubhouse. Good morning to you. Good morning to you. Good morning to you. So let's see. Aaron Jones says Grand Rising on this first day of the week. You got this right. A first day of the week. You got that right. Because yesterday I was in church. So today, first day of the week, let's get started. I absolutely love that. So folks, let's go ahead and let's put some things on the screen right now. These $200,000 houses, and then you can get a 30-year mortgage on these houses. So we're going to show this on the screen right now. Okay. So $200,000 houses right here. Here's one. These are 200,000. This is right here in the Huntsville area, Huntsville, Alabama. That's where we are. $200,000 houses. And I dare say that most of these have 30-year mortgages on them. All right. They're not, some of them are not bad looking houses. Okay. Some of these are not bad looking houses like this one here. All right. You know, I don't particularly care for front loading garages. I like side loads. But here, this is a 2-bedroom house in Huntsville, Alabama, under 200,000, but you can still get a 30-year mortgage on it. This house right here. Okay. Here is what I want to show you and help us to understand. Here are some other things you can buy that cost 200,000. Here are some $200,000 cars right here. $200,000 cars. And these car companies are not going out of business. They're doing hundreds of thousands, not even they may even doing millions of cars a year, and they're not going out of business. Do you know the difference between a $200,000 car and a $200,000 house? Do you know the difference? The difference is you can't get a 30-year loan on a $200,000 car. This car, if you buy it on time, has to be paid off in 8 years or less. Has to be. You can't get a longer loan on this Rolls Royce that I have pictured here. You cannot. So if a $200,000 car has to be paid off in 8 years, why do most mortgages take 30 years or more? In fact, 9 out of 10 people you know will never pay off a $200,000 mortgage in their lifetime. But this car has to be paid off in 8 years. Anybody ever wonder that? What in the world is going on? And you deserve to know the truth. And we're going to jump right into this right now. So I'm going to put, right now, we're going to put this on the screen. All right. So on the article that I have up, all right, we're going to go to number 94, all right, and we're going to be looking at historical context, okay, and we're going to start there. So on this thing, where did this all start? Before the 1930s, you could not get a long-term loan on property. It didn't exist. All right. So you had to have about 30 to 50% down. All right. And they were mostly interest only loans. And they were like 3 to 5 year terms. And some of them even were renegotiated every year. Now, here is how it worked. Here's how it used to work. Based on this article, that when you got a mortgage, on your home or on your business or your farm or whatever it was, all right, that you had to have a lot of money down, and you made basically interest only payments. Well, how did you pay it off? Well, you didn't. At the end of 3 to 5 years, there was what we now call a balloon payment. All right. At the end of 3 to 5 years, depending on what your term was, you had to pay the rest of it or refinance the loan. You had to do that. That's the only way you could do that. All right. Now, very few people could pay off that balloon payment, so they refinanced the loan. But in 1929, it all came to a screeching halt. Most people in the Great Depression who lost their homes or their farms or their businesses or their churches so that they couldn't pay for anymore, wasn't because they couldn't make the monthly payments. It is because the banks would no longer refinance those loans. And because of the fact that the property values dropped, that these folks said, I'm calling this loan. I need my money. I am not going to refinance this loan for you. And because they could not pay the balloon payment, there were a ton of foreclosures. The foreclosures put a downward pressure on the market, and it made it even worse. So the banks could not even sell those properties, and it just went crazy. Now, in the 1930s, starting in 1934 through 1936, they started to revamp this thing. All right. So if we're looking at the historical context here, all right, I'm changing over to page 95. Boom, boom, boom. All right. So in this, let's see, the homeowners right here. All right. I'm starting here. Okay. Let's see. The Homeowners Loan Corporation raised funds using government-backed bonds, used the funds to purchase defaulted mortgages from financial institutions and then reinstated the mortgages. Oh, how about that? Thank you, HOLC. This started to pull us out. The HOLC changed the terms of the mortgages drastically, converting variable rate short-term non-amortizing mortgages into fixed rate long-term 20-year fully amortizing mortgages. Right here, they started out with 20-year fully amortizing mortgages. Let me ask you right now, before we go any farther, have any of you ever had a class on the amortizing mortgage? Yes or no? Please put it in the chat. Okay. Model Kenya Smith says, "How can I watch on Facebook?" Go to if you want to do this on a separate device. Okay, you can go to your search for P.I.L.L method on Facebook, and then you'll see our live show. Search for P.I.L.L method on Facebook, on YouTube, on Twitter, on LinkedIn. Just search P.I.L.L method on, and then you'll be able to find our live. All right. Now listen. So Tori says no. San B says no. Taro Cash says no. All right. Let me see what's going on online here. All right. Anybody else online saying, it says, can you post the link on the Facebook Live as well, please? All right. Go to ice10k.com and the link is there. All right. Let me get that. Let me get that for you. All right. Let me pull this up. Oop, get this over here. All right. Let me go to ice10k.com and then we can post that link. Ice10k. Uh-oh, I don't want to put it there. Let me put it here. ice10k.com. All right. And then we have, okay. Ice10K Live. So when you go to that, ice10k.com, you will see the third button down that says Ice10K Live. All right. So when you click on that, you'll see all my live stuff. So you can go to Facebook, Twitter, all of these. So let me go ahead and copy the link. All right. Copy. And we're going to post it right here. All right, paste it there, and there it is. That is the link that will take you to our Facebook. All right, there you are. But if you go to Ice10K Live, and then you click on Ice10K, ice10k.com, and then click on the button that says Ice10K Live, you'll see all of our live buttons. Now, let's get back to this thing. All right, get back to this thing. Now, we have 20-year amortizing mortgages now. Now, why is that a bad thing? Listen, this 20-year amortizing mortgage made it possible for people to be able to start buying their home instead of paying just interest-only payments. Because when you amortize a loan, guess what happens? You start putting money on principal and you start building equity. All right. But because people didn't know really how it worked, nobody taught them, there was something that was going on in the background. Okay. So let's figure this out. So let's see. Let me see here. So we're going to go down because we're going to start here on this paragraph. Because the federal government did not see itself as being in the business of holding mortgages in the long term, it needed to find a way to make these mortgages marketable. So they had to find a way to sell these mortgages. Watch this. In particular, the investors, here come the investors in the mortgages wanted assurance they would receive the full principal balance and scheduled interest payments. Listen, if I can get scheduled interest payments for the next 20 years, that became something that would be valuable to investors. All right. So they found a way to securitize these loans or package them up and sell them to investors who could so that they could manage the properties and get these long-term interest payments for the next 20 years. So folks, was it in the government's was it in their interest to teach people how mortgages actually worked? Was it in their interest? No. For investors, was it in their interest to teach people how mortgages actually work? Because if you can pay off a car in 8 years, but it takes 20 years to pay off the same price house, something is going on here, and it has to do with the amount of financial education that we have or don't have in these areas. We're expected to use these loans, but none of us have been educated on it. In fact, we've been told that they're actually quite simple. All you have to do is pay more and you get out of debt faster. These things are very complicated. When you see the formula was invented in the 1600s by a guy named Fibonacci. It is a very complicated formula, and it is very expensive to operate. Now, how can I have a payment that is affordable, but at the same time expensive to operate? That's the benefit of these long-term loans. What else do I have here? Okay, so I says now, because the government did not see itself being in the business of holding mortgages in the long term, it needed, let me go back here. Let me see if anybody's raising their hand, wants to come up to the stage. All right, raise your hand, come up to the stage, make a comment or ask a question. All right, now remember, download this article. Download this article if you see it. You are going to want to have this. In particular, investors in the mortgages wanted assurance they would receive full payment, all right, the full principal balance and the scheduled interest payments. While some private mortgage insurance companies were in business for this purpose before the 1930s, they were insufficiently capitalized and failed in the early 1930s. Okay, now let's go down to the next paragraph here. This is something interesting. Thus, the invention, watch this now, thus the invention of the fixed rate, self-amortizing long-term mortgage. Long-term mortgage? Why did they invent a long-term mortgage for 20 and 30 years? When cars have to be paid off in 8. Come on, folks. The reason why we have long-term mortgages is only because we have not been educated on how they work. And this is the purpose of the P.I.L.L method today, to make sure you listen, you have the right to know, and no one else is teaching it. So we have dedicated ourselves here at the P.I.L.L method to make sure this information gets out. Let me start over. Thus, the invention of the fixed rate, self-amortizing long-term mortgage was above all else a response to the general financial crisis as opposed to a design for the promotion of home ownership per se. FHA adopted this form of mortgage to avoid the problem of people needing to refinance, which had clearly led to disaster. Remember, they were refinancing every 3 to 5 years. And yes, it led to a disaster. And so they said, now, what can we do to help people pay off the loans, all right, gain equity, reduce the risk to the lenders, okay, and eventually have a way for people to actually pay this money back to their lenders. How can we do that? How can we do that? They came up with these long-term loans. Now, why did they make them long-term? And I said they had to. Now the government came and stepped in and bought up a bunch of mortgages and then reissued them. But the government didn't want to be in mortgages. So what did they do? They made it attractive for investors to buy the mortgages. So they converted from these old type of mortgages to these new type of mortgages where the investors could count on getting money long term. Now, here's the thing. If 9 out of 10 people never pay off a mortgage, people who are investing in mortgages think this is a safe bet. The only way it continues to be a safe bet, that you never learn how it works and start treating your 30-year or 20-year mortgage like an 8-year car payment. Start treating your mortgage like a luxury car, and you can save a ton of interest that the bank was looking for. So it started in 1934, and then in 1936 there was a change. Let me see if I can find it. Okay, so let me see here. Where are we in the article? Thus, and then I skipped a little bit. Okay, start here. All right. Let's see, the new long term. Where is that? Okay, there it is. The new long-term mortgage. Okay, the new long-term mortgage was, of course, no panacea for U.S. banking problems. 1/3 of U.S. banks failed during the Great Depression. All right, but it did help. These loans did help. All right, so turning over the page. Boom, boom, boom. All right, now let's see here. Let's see, the Homeowners Corporation. Let me see. We're on page 96. All right. And this was invented as a government agency in 1938 for the purpose of abetting a secondary market in FHA mortgages. You know, I saw this word abetting. And this is great. This is crazy. I need you to watch this. In particular, all right. Let's see. They invented this. It was invented as a government agency. The Fannie Mae was invented as a government agency for the purpose of abetting a secondary market in FHA mortgages. Let me show you something here that I found interesting. All right. I'm going to, let me see here. Click on this and let's see, bet. All right. All right. A-B-E-T. All right. And I want to look up the definition of a bet. Okay. Now, I need you to read this. This is the first definition. Check this out. Encourage or assist someone to do something wrong, in particular to commit a crime or other offense. So you can help somebody do something good or you can help somebody do something bad. But it was just funny to me that the very first definition of a bet was to help somebody do something wrong. Okay, so let's get back to the article. All right. So, all right. So here we are. Where are we here? All right. So that in particular, Fannie Mae issued bonds for purchasing mortgages at par so that the investors in affluent communities could invest with confidence in mortgages in communities with little local capital. Okay? Buying at par meant banks had no exposure to no exposure to interest rate risk when lending long term and funding these loans by Fannie Mae issued bonds. So they were making it safe for investors to invest, at the same time ensuring them long-term profits. If you want this article, all right. So Brother AJ says, pull this article right up on Google Scholar. There is a complimentary download available as well. Thank you for that, my Brother AJ. Listen, folks, we are now learning some of the background behind 30, 20, and 30-year mortgages. Okay, so now let's go down to another paragraph here. Okay, with the anticipation, starting here, with the anticipation of the end of World War II, the GI Bill of Rights, officially known as the Servicemen's Readjustment Act of 1944, included within the GI Bill was the invention of the Veterans Administration Mortgage Insurance Program, a program that allowed veterans returning home to obtain mortgages with very low down payments. The program was intended both to reward veterans and to stimulate housing market construction. At about this time, the Federal Housing Administration also sought to stimulate housing construction by substantially liberalizing its terms. In 1948, here we go. In 1948, the maximum term of the mortgage rose to 30 years from the initial maximum of 20 years. Now, how in the world could they go from 20 years to 30 years on a loan that actually could be paid off in 7 or 8? Because all of the education, everything that was being told to prospective home buyers, conditioned them to think of these as long-term loans. If I was an investor and I was told that I can count on these interest rates for 20 years, I certainly would not want people to know that they could actually pay it off in 7. I wouldn't want them to know that. Listen, folks, does this make sense to you? Listen, put something in the chat. Is this making sense to you? That what's going on here is a lie by omission. A lie by omission. They could tell you, we could do classes on how to treat these mortgages like we do cars. They could do that, but they're not doing that. What we're teaching can be taught in 7th or 8th grade and can be understood by middle schoolers. That's how easy it is for banks to continue to make these profits. Okay, for banks to continue to make these profits, all they have to do is make sure you never find out how it works. And that's why When you become a real estate agent, putting people in 30-year loans, this is why you are not taught how a 30-year amortized long-term mortgage actually works. You don't need to know that to get your license. If you are a real estate agent in here, you tell me, did you get that education? Not only that, folks, but if you're a loan officer and you're in here, an MLO, you work at a bank, your job is to sell people mortgages. Guess what? Now that you have to have a license, you would think this article that I found on the internet, you think this would be part of your education, but it's not. You would think that mortgage officers would understand how a mortgage actually works, so that they can help their clients become more efficient in paying back the loans. But you see, the thing is that these mortgages are packaged up, especially the fixed rate mortgages. You're going to read, when you read this entire article, you're going to find out that the fixed rate mortgages are sold on the secondary market so that the people who are holding the mortgages won't get caught if the interest rates rise, because they're fixed rate. As soon as the interest rates rise to a certain point, they start counting the money as a loss. The money that they're making, they start counting it as a loss. Now, here's what you need to understand as a loss. When the interest rates are right, and I'm making X amount of dollars, all right, let's just say I'm going to give you an example here. I'm making $100,000 on the deal. I'm making $100,000 on the deal. But how business works, if something happens where I'm only making 90,000, they don't look at it as making 90,000. Okay? Can you please post the link for the article on Facebook Live, please? No, because we're not over there. We're not over there. All right. If you want to, if you should be able to see it, let's go ahead and put it on the screen so anybody who's watching it on Facebook can be able to see that link.
John.
Yep.
For that user on Facebook, they're in a group.
Okay.
They're in a private group, and we cannot post links to a private group. And that's one of the reasons why we can't even see your name. So, I saw your comment earlier. I tried to show you that we posted it on Facebook. It's posted on Facebook.
Mm-hmm.
We can't post it to the private group. So if you find the page on Facebook, sir or ma'am, whoever's on Facebook in that group, in that private group, you'll be able to see the link. But this is not a limitation of the P.I.L.L method. This is just the way Facebook does it. They don't allow us to post in groups. So you're watching in a Facebook group, and that's the reason why we can't share it there. So,
all right.
And it's a very long link. So it's better to click it than to try and, I'll put it back on the screen again. I have no problem doing that. But
all right.
Just wanted to let that know.
Oh, well, thank you. Thank you for that. Thank you for that. So I wish there was a way to get it over to you, Facebook user. But listen, we're going to make sure that this particular show stays up forever. And we're going to find a way to, if you will message me, all right, send us a message on Facebook. I will send you the link. How's that? All right. Message me on Facebook and I'll get it to you that way. All right.
Excellent. All right.
Listen. Thank you. I was able to screenshot it. Folks, what we're talking about is historical data. All right. On how these loans actually work, and for the banks to continue to use them and to securitize them so that they're attractive to investors. You can't know how to make these 30-year loans into 7 or 8-year loans. You can't know that. So I love the word. When I see, I love words. So when they said that they're using this system to abet the secondary market, listen, I was floored. I was floored. Okay, so 97 on page 97, I have some more. Let me see here, page 97. All right, with the strong. Okay, here we go. With the strong expansion of the U.S. economy in the post. Let's see. Here we go. All right. Somebody go ahead and somebody got to mute their mic. Okay. All right. Somebody's got to mute their mic. All right. Who's that? Okay. Go ahead. All right. So now, let's see here. With a strong expansion of the U.S. economy in post World War II, and this is where I'm reading from. If you're looking at online with me, okay. The post World War II period driving up incomes together with the new institution of the long term. Look at this, the long term and therefore affordable. Watch this. It's affordable because it is long term. It's a payment you can afford, but the payment is very expensive at the same time. And I'm going to show you some numbers as to why these things are so attractive to the secondary market. Okay. Therefore, affordable, fixed rate, self-amortizing mortgage, home ownership expanded rapidly. America was transformed from a nation of urban renters to suburban homeowners. Listen, folks. When a particular market starts to take off, somebody is going to get in on this thing and start noticing there's money to be made. When they start noticing that there's money to be made, they're going to say, listen, how can we expand this thing? They're going to come up with new products so that you can buy a house, and here's how they're going to frame it. Why are you going to rent? Why are you going to rent when you can become a homeowner? And not only that, but we're not even going to teach you how the loans actually work. So that when you get the loan, you get a payment you can afford, but it's also expensive at the same time. So I'm going to, for some of you who are new to the room, who are and you want to see what I'm doing on screen. When you first came in, I put this on the screen. Okay, I put this on the screen. I've got some $200,000 cars. I'm putting that back on the screen right now because you may not have been in here when we first started. Okay, here's some $200,000 cars, and I don't care where you go. All right. Look at this. All right. Look at these cars. If you buy this car on time, you have to have it paid off in 8 years. They will not lend you money for more than 8 years on this car. Okay. But let me show you something here. These are houses in Huntsville, Alabama. You can get a 30-year loan on this house. This one right here. On this house, you can get a 30-year loan on this house. But if you park a $200,000 car at this house, it has to be paid off in 8 years. And no one is stopping to ask the question, why is that? We are here to make sure that you understand the difference. I have some folks on the stage. I got Bam. I got Anthony. All right. Bam, are you getting this? Are you getting any of this?
Well, let me say this, King Iceman. I come into your room to learn, and I'm going to quote Alvin Toffler. And let me ask you a question, kind of, because this is so deep. And yes, Alvin Toffler says that the illiterate of the 21st century will not be those who cannot read or write, but those who cannot learn, unlearn, or relearn. So King Ice, you drop so much knowledge, man. And just spoke in the audience. Be open to learn. Be open to unlearn and relearn because it's a new world. I'm Brian Franklin, and I approve that message, and I'm done speaking. Bam.
Thank you very much for that, Bam. Listen, we have Anthony Glenn here, who is an expert. I mean, an absolute expert and genius on that VA loan. Anthony, how are you this morning, sir? Maybe he can't talk right now. All right. But when you can, Anthony, I jump in there whenever you can. Anthony Glenn, folks, you want to know about getting that VA loan? He can show you. And if you want to know how to treat that VA loan like a luxury car, then you want to contact the P.I.L.L method. All right. So listen, folks, we have some folks online who are watching us, and we have some folks that are in here on Clubhouse. I need you to start sharing this room right now. Go ahead and start sharing this room right now. Let's get this information out here because you deserve to know the truth about mortgages and lending. All right. Here is what's happening. When these mortgages went out, this is key. This is key. All right. I'm going to start this paragraph over again. With the strong expansion of the US economy in the post-World War II period, during driving up incomes, together with the new institution of long-term and therefore affordable fixed rate self-amortizing mortgages, home ownership expanded rapidly. America was transformed from a nation of urban renters to suburban homeowners. The ownership rate among U.S. households rose from 43.6% in 1940 at the last census before World War II to 64% by 1980. The Census of Population and Housing, 1940 to 1980. The FHA mortgage was a key to this transformation. There was gold in them dar hills, ladies and gentlemen, because people were now getting these mortgages and they could now become home buyers, and this became part of the American dream. But on the back end, somebody was making a lot of money because the home buyers did not fully understand, not even fully understand, they didn't even begin to understand how a 30-year self-amortizing mortgage actually worked. Now that you know the background, now that you know what's behind, I got Sister Sue want to come up to the stage. All right, invite to speak. Anybody else who wants to raise their hand, come up to the stage. Listen, you're in the mortgage syndicate this morning, and we are talking about the truth about the mortgages and lending. And I'm giving you some historical data, and I have on Clubhouse. Click this link, and you can download this same article that we have here that gives you all the sauce on what we're talking about today. And now you can understand. Now you understand why. Okay, I'm gonna break it down to you. Here's a short list of people who do not understand what you're getting ready to learn today. Okay, your CPA is not taught how the self-amortizing loan actually works. Your real estate professional is not taught in their classes how a self-amortizing mortgage works. Okay, your mortgage professional, the one that sells you the mortgage, to get their license, they don't know either. Okay, your financial planner does not know. If you know somebody who is even a Harvard educated business person, it's not taught in any of their classes either. How in the world that I'm just asking folks, you have right now the most ubiquitous financial tool on the planet is the amortizing loan. And none of us have ever had the education on how it actually works, so other people can make a lot of money. Okay, Sister Sue, I see you there. Did you have a question or a comment?
I'm just enjoying this so much, because when you say nobody, and you point out how they have manipulated the education of the people that are professionals, so that they would actually lead all the little sheep into that corral. And so the fact that even the VA and the small business development centers since 2010 will not let the veterans, so I gave a veteran a 10-year mortgage at 3% interest. He was homeless. This is a graduate of the Naval Academy that was a Marine. And, in the service and in camping, we're trained to enjoy the great outdoors. And what they're doing is creating pigeons that get used to being homeless, and they feed them with drug and alcohol, and they gloss over their trauma. And that they will take the bait. So my father was a research scientist that was luckily he got his alcoholism days over with his freshman year in college, because back then parents were notified about the grades. And now, guess what they tell us nurses? Nope, these college students, they're adults. You cannot notify the parents. So if you see a kid going down the tubes, they want that kid to get in debt. And when they arrive at the college campus, they are told, congratulations for being so smart and getting into college. We're putting our money on you. And that's the credit card people. And they say, whatever you do, you have fun. But whatever you do, you make sure you make that minimum payment, because you're developing your credit score.
Well, let me listen, Sister Sue. I thank you for that. But listen, I need you and everybody else here, that there are some very savvy people who have perfect credit. And I'm going to show you today how somebody with perfect credit, by not understanding how the self-amortizing loan actually works, can be directed to pay 100 to 200 to 300% interest on a loan, and they don't even realize it. And I'm talking about
actually read the amortization schedule.
Yes.
And then we point out applied math. They'll go light bulb. They'll be like, well, gosh, I'm just giving my money to other people.
Exactly.
And that is happening in all insurance things. Now, the only form of insurance that I really advocate for, I believe every married couple and that truly love each other, and I say, you better marry a friend that you trust. Don't get sucked into this high maintenance fashion.
Sister Sue, I appreciate you, but I got a 2-hour show here. I got a lot of data I got to get in.
Go, but I just want you to know that I grandmother in any intelligent life form that is willing to use me and my Wellness Weavers Global Trust Fund correctly, because boy, did I make these highfalutin intelligent people mad that use their actuaries to actually lead people astray. Right. So I gift.
All right. Thank you, Sister Sue. Sheila, what's going on with you today?
You're talking to me?
Yes, ma'am. You raised your hand. Did you have a comment or a question today?
No, I wanted to be on stage, but I'm a fan of the P.I.L.L method, and I'm teaching it to my young adults who are purchasing homes, and I'm just trying to freshen up on it some. So,
well, thank you very much for coming to the stage. You know what Miss Sheila is doing, ladies and gentlemen? She came to the stage. Okay, she's coming to the stage for just so that she can sit on the stage and learn. And when she does that, guess what? She has 410 followers. When she hit my stage, every one of those 410 followers got notified. So she's helping to populate the room just by sitting on the stage. So if you want to come to the stage, you don't have to say a word, but you're helping out by just parking yourself on the stage and wanting to learn. So come on up and learn from the stage. I said, Dr. T has raised her hand. So come on up, folks. Come on up and help me out. Now, if you are not a member of the Mortgage Syndicate, all right, I see you with your red ticket. You want to join this house. Join the house. Also, click on my avatar. All right, click on my avatar and then join the P.I.L.L method house as well as follow your moderators. We're here in the Mortgage Syndicate today, and you deserve to know the truth about mortgages and lending. If you came in late, you want to catch this from the beginning, you can listen to the replay here, or you can go to YouTube, Twitter, LinkedIn, and Facebook. Search for P.I.L.L method, and you can watch the whole thing and see the examples as well. All right. So, ladies and gentlemen, so Dr. T, did you have a particular question or comment, or did you just want to enjoy sitting on the stage today? And go ahead. Nope. She says, can't talk.
Good morning.
Good morning.
With the mic this morning. Thank you so much for allowing me up on stage. I'm just hoping to bring whatever followers I have to your room. I'm here to learn. I have a lot to learn. And so, yeah, my mission is to empower at-risk youth and several other underserved and underrepresented populations to build a community of hope for them and their future generations. So thank you for allowing me on stage.
Thank you. Thank you for being here. Thank you for being here. And I see Tammy. Tammy, what's going on with you today? Uh-oh. Miss Tammy? Tammy going once? Tammy going twice? All right, that's okay, Tammy. All right, ladies and gentlemen, I'm going to...
I'm sorry to interrupt.
Yes.
Can you mute me? I'm having trouble with muting myself. If you could mute me, that would be... Thank you.
Got it for you. You got it. You got it. You got it. Okay, Miss Jessica. All right, did you have a question or a comment while I'm taking a little break here?
Hello, everybody. I just a comment. I've been aware of some of the rooms and new to the real estate industry. I have several partnerships with different investors, and my mission is to empower people with disabilities, especially in the blind, low vision community that I'm in, to have home ownership and also creative wellness initiatives. So I'm here to learn and pursuing my real estate license in New York State.
Thank you so much for being here today. Miss Deborah, I see you came up. Do you have a question or comment before we jump back in?
Not yet, brother. I am new to the business as well, real estate business, and I'm just here to learn.
All right. All right. So now we have gone over some of the historical data, all right, on how after the Great Depression, how 20 and 30-year self-amortizing mortgages came into play, and it helped pull the economy out of the slump that the economy was in. But then the government, who bought up a bunch of mortgages, all right, says we have to get out of the mortgage business. How can we make the mortgages that we bought and got these things restarted? How can we make them attractive to investors? And then they invented 20-year self-amortizing mortgages in 1934 through 1936. In 1948, they went from to 30-year mortgages. And at that time, then after the World War II era, we found out that home ownership just skyrocketed after that. I mean, home buyership. Homeowners is when you actually pay it off, but home buyership went way up. And then when these people get mortgages, they're often sold on the secondary market. They're packaged together and they're made long-term securities. And so when people get these securities, they're counting on these 20 and 30-year mortgages to provide them income for that period of time. And therefore, we're not taught how to treat a 30-year mortgage like a car. How would you like to know some of the basics behind how a 30-year loan actually works? I need you to put a number 9 in the chat if you or online if you want to see how you can understand how all this thing works. And it's so simple. It's so simple. All right. To learn how to read an amortization schedule. All right. I see the number 9s coming in. All right. But we're going to look at how to understand the basics of the amortized loan. Okay. So we're going to put that on the screen now. I need you to understand this. Okay. Anybody can save money on a mortgage and pay it off before 30 years if they choose to. But the way that these things are constructed, there is a way so that you can optimize interest savings by using the P.I.L.L method, by paying the right amount of money in the right month on the right day of the month, so that you can save the maximum amount of interest per dollar applied. What I'm getting ready to show you is just the basics. This is not my program. These are the basics that every 8th, 7th, and 8th grader should learn. But we're going to find out that there is a formula or a computer program that can beat the bank's computer program so that you can pay off the loans as cheaply as possible. Let's jump into it right now. So we're going to put something on the screen here. All right. Let's get this out of the way. All right. Pull this up. I'm going to put an amortization schedule on the screen. All right. Now, I use this tool as a teaching tool. It is, you can go to brettwhistle.net. Anybody can get this tool. This is not my program. I did not write it. Okay. My program is a lifetime program. We have our own, what we call an opportunity cost calculator. All right. It is a cloud-based AI system that will guarantee that you will pay the least amount of interest possible. But what we're doing with this is showing you how you can help yourself and maybe young people that are in your charge understand the basics of how amortization actually works. And let me tell you this, practically everything you know to do right now to save money on these loans is wrong. If you have a question about something that has to do with amortization, if you have a particular theory as to what you've learned in the past and you want to share it with us today, I will show you where the bank makes money on it and where we shouldn't be doing that. Practically everything that we call best practices is based on a misunderstanding of the self-amortizing loan. Okay, so let's get started. All right, if you want to see this, go to YouTube. All right, and I'm going to take this. I'm going to take this article down. I'm going to take the article down, and I'm going to put up my my 10K card. All right, which is ice10k.com. Okay, ice10k.com. There you go. All right. So we're putting that up. But if you want to see this, you can click on that link. You'll find my Ice 10K live button. and you'll be able to go to a secondary device, your tablet, your secondary phone, maybe even your laptop, and bring up YouTube on that and then search Pill Method, and then you'll be able to watch this live as well. Let's start understanding how all of this works, okay? So we got a $200,000 mortgage at 6% that I'm putting on here. Now, the payment is $1199.10. Remember, I was showing you the difference between a $200,000 home and a $200,000 car. Let me show you what's going on here with these amortized loans. When you have a 6% loan amortized, the bank wants you to pay back over 30 years. This is why it's so attractive on the secondary market. I can purchase this on the secondary market, this $200,000 loan, and I'm going to get back $231,676 in interest on my $200,000 loan. Folks, that's not 6%. That's 115.838% all day. If you were an investor that were buying up these loan securities, would you like to buy some of these? Yes or no, if you were an investor? Go ahead and put it in the chat. Yes or no? If you were an investor, would you be interested in buying this? If people didn't understand how it worked, and most people never pay off a 30-year loan, never. They never pay it off. They can count on this money. They can count on it. Somebody saying for sure. Yes, absolutely. Let me show you what's going on here. All right. In the very first payment, because the self-amortizing loan, a portion of the payment goes to principal and a portion goes to interest. $199.10 goes to interest. I'm sorry, to principal. $1,000 goes to interest. Let me tell you something. When you're buying a home and you borrow the money, I'm sharing with you what's really happening behind the scenes. The bank is purchasing your equity. The bank is purchasing your equity. And now, because you didn't have the $200,000 in the bank, you can now borrow it from somebody, and they're going to give you a payment you can afford because it's over 30 years. You can pay the $1199.10. Do you know why you can pay that? Because it's much cheaper than the rent you are currently paying. Much cheaper than the rent you're currently paying. But that $1199.10 is also very expensive at the same time, because what you're doing, you're buying the equity back from the bank. When you make that first payment, $199.10 went to principal, meaning you just bought $199.10 worth of your equity back from the bank, but they charged you $1,000 for it. Do you understand what's going on here? They just charged you $1,000 to purchase $199.10 of your equity back. You're a home buyer. You're not a homeowner yet. Okay? Now, anybody who wants to come to the stage and ask questions about this, please do. All right? So I'm going to try to watch the stage, and I'm going to try to watch my screens. And I've got Kurt Nugent. He's watching it, and he's going to highlight something. If somebody asks a question, he'll highlight it. It'll get my attention so I can see it. Now, when this $199.10 is applied to principal to your $200,000, you're left with $199,800.90. The bank then uses this number to figure out how much interest to pay. How many of you would like to know how in the world the bank can use 6% and we end up paying $1,000 worth of interest on that very first payment? Would you like to know the math that the bank uses? And I promise you, it is math that a 7th or 8th grader could understand. If you want to know how to do this, just put in a number 7 into the chat. Put a number 7 in that you want to see the math, how the bank actually does this. I'm telling you, This self-amortizing loan is not taught anywhere. And because it's not taught anywhere, everybody who's using it is totally unaware of what's going on behind the scenes. And I'm going to show you how it works right now. Okay. So we're going to put a calculator on the screen, and we're going to show you this. We're going to show you this. Watch this. We're going to take that 6% interest rate, 0.06, and then the formula that the bank uses, the formula that they use is right here. Let me show you the formula. All right. The amortization formula. Okay. Amortization formula right here is right here. All right. Let me bring that over. Okay. Amortization formula. There it is. Okay. We're putting that in the middle of the screen. Here's the formula. This was invented by Fibonacci in the 1600s. We didn't start using this formula until 1934, 1936. For the last 80 some years, practically no education has gone out to understand how this thing works. And this is what makes it so attractive to investors to pick up your mortgages on the secondary market. This thing right here. Okay. So let me show you now how they're doing this. We're going to take what this formula does is this. They take the 6% interest rate and divide it by 12. You get 0.005. And then they take that number and multiply it by the principal amount. So when we multiply it by the $200,000, so we multiply it by 200,000, there it is. Our first interest payment is $1,000. It's right there. Okay. And then what they do is next is when the $199 is applied to principal, your new principal balance is $199,800.90. For the next month, they do the same thing. They take that 6% interest rate, divide it by 12. They get 0.005 and multiply it by the new balance, $199,800.90. $199,800.90 equals, I hit the wrong button. I got so excited. All right. 0.005. All right. And we're going to multiply it by 199,800.90 equals $999. Look at here, $999. So if you were thinking that what the bank does is take 6% and multiply it by the whole amount and come up with your interest payments, that's totally wrong. What they're doing is this. Every balance you have, they're multiplying that balance by 1/12 of the interest rate. So you don't have one mortgage, you have 360 separate mortgages. You get a brand new mortgage every month for 360 months. That's 30 years. Now, for this thing to continue, you can never know how they do it. You can never know how they do it. I'm going to show you something simplistic. Now, it is not the entire program by any stretch of the imagination, but what you're learning today, you can save some money. All right. Now, remember that the bank uses, because they use this particular model, it makes them, the investors, a lot of money. By the same token, there is a huge weakness or a gap in this system that you can save the same amount of money that they're actually charging you. But because you don't know how it works, we just get in the habit of making that regular payment. And when we get in the habit of making that regular payment, look what happens. At the end of 1 year, you pay the loan down by $2,456 and a penny. You just bought back $2,400 of your equity, but look how much it cost you. $11,933.19. Absolutely. Listen, I got to ask the question. I got to ask it. Is that too much money to pay? I mean, the payment is affordable. $11.99.10. I can afford to pay it, but it's also expensive at the same time. Do you think almost $12,000 paid out so that you can purchase $2,456 of your equity back? Is $12,000 too much to pay? You better believe it is. What can we do about it? Here's what we can do about it. All right. I need you to listen in very closely. Let's pretend we're making this very first payment in January. All right. When I make my very first payment in January, $11.99.10, $1,000 just went to interest. In your document, you have something in there, it's probably on the mortgage note page, that you have the right to prepay principal. Prepayment of principal means that anytime you give the bank money before it's due, you can have it applied to principal. Yeah. But what most people don't know is what happens when you do. Let me ask you a question. If you buy something on sale at your department store, what do they print at the bottom of the receipt when you're checking out? Yeah, you know, they print how much money you saved. Do you believe if you prepay your loan, give the bank money before it's due and they apply it to principal, are you saving time and are you saving interest? I think we would all agree that the answer to that is yes. You're saving time and you're saving interest if you prepay. The problem is our focus. We're focused only at bringing down the principal. We're not focused on how much interest we just saved. And the interest savings is key to managing your debt. Not how fast to bring down the principal, but how cheaply you can pay off this loan. That is the key. So when I make my first payment in January, my next principal payment for February is $200.10. $200.10. That's my next principal payment. Here's my question. Do I have to wait till February to give the bank that $200.10? Put it in the chat. Put it in the chat. Put it online. Do I have to wait till February to give them the $200.10? No. I could actually pay it ahead of time. Now, practically every one of you, when paying back a loan, has put extra on the loan. You put extra towards principal. Has the bank or credit union on any one of your loans, whether it's a mortgage or car loan or a credit card, if you paid extra when you got your receipt, did they print on that receipt how much interest you saved and how much time you saved? Yes or no? Have you ever gotten a receipt from the bank and saying, here's how much interest you saved? Bam saying, nope. Everybody's saying, nope. We've never been told this. Do you know what's worse, ladies and gentlemen? Do you know what's worse? How we've been conditioned to spend our money? What's worse is it never even occurred to you to even ask how much interest you saved. Think about it. Let that marinate for a minute. We're so used to giving them money, we didn't even know what we were getting. Listen, folks, when you purchase something, when you pay for something, you're supposed to get something in return, and you do. It's just that you don't know what it is. And today, because of the system that the bank is using, this self-amortizing loan because they chose to do that because it makes a lot of money. I'm going to show you how it saves a lot of money if you learn how to read this thing. So we just paid the mortgage in January, but the principal payment for February is here. What if we were to prepay the $200.10? Okay, what would happen? What would happen if we prepay the $200.10? It goes to principal. You're paid down to line 2 in January. So when the bank is trying to figure the next month's interest payment, they have to use the $199,600.80. They can't use the $199,800.90 because you don't owe that anymore. This is what you owe. And when we bring up our calculator to do the $199,600.80, and we multiply it by the 0.005, it comes to $998. That is the interest on line 3. So this is our payment. So what just happened? For 200, excuse me, I got to get a drink, folks. Hold on. Okay, so here's what happened. For $200, I get to skip down to line 3 on this amortization schedule. Line 2 has been eliminated. So normally it would take $1,199.10 to get rid of a line. I just showed you what happens because of the self-amortizing loan, what happens when you pay the $200.10 early. Line 2 has been eliminated, and you just dropped down to line 3. So you just turned 360 monthly payments instantly into 359 monthly payments with just $200.10. Now I need to know that $999 that they wanted to charge you, what happened to that? What happened to that? Somebody says, is the replay on? Yes, the replay is on. The replay is on. Plus, you can see the numbers. You can see everything on YouTube, on Facebook, Twitter, and LinkedIn. You can see the numbers. Just go to any one of those and search for P.I.L.L method, and you'll be able to see the live or the replay. Okay? So by doing this, by paying the $200.10 early, you just eliminated or canceled $999 worth of interest you never have to pay. That's how weak this thing is. And we've never been told this. Not even your loan officers know this, because the investors that are benefiting long-term from your mortgage, they don't want you to know. They don't want you to know. Anybody got any questions or comments about what we've done so far, about what you've learned so far on this? Okay. I got Miss Keisha here, got her hand raised. All right. So come up to the stage, ask your question. All right. She just turned that hand raising off. Okay. Sorry, Miss Keisha. I guess you didn't want to come up. Okay. Raise your hand if you want to come up. All right. All right.
My comment is in my emoji. This is hot.
Oh,
I'm done speaking. Bam.
thank you, Bam. Listen, folks, what is going on? We just saved $999 we don't need to pay that the bank was looking for, that you thought you had to pay. You thought you had to pay that. So what would happen? Man, oh man, Sister Sue, what would happen? What would happen if I made this very first payment in January and I gave the next 3 principal payments, $200.10, $201.10, and $202.10. That's $603.30. What if I went to my bank account that's making 1/10 of 1% in my savings account? What if I had a couple of a couple of bucks in there? I could take $603.30 out of my bank account. Could I apply that to principal? Could I apply $603.30 to my principal? Okay. All right. Black Girl Digital wants to know what happens if I pay an extra $1,000. I'll show you. But right now, we're going to do $603.30. Look what happens. Look what happens. All right. We just eliminated nearly $3,000 in interest we don't have to pay. And our next mortgage payment is on line 5 of this schedule. Has anybody ever showed you guys this? This is why this historical data is so powerful, and it'll show you how much money is actually being made here. Ladies and gentlemen, there is a lot of money being made here. And I just showed you how to save a ton of money with a small amount of money because you reversed the leveraging process that the bank is now using. And all you had to do is know how the thing actually worked. And I want to ask you, have I shown you anything today that an 8th grader could not understand? Okay. So, all right. So, Black Girl Digital watching us on YouTube, she says, "Well, if I made my mortgage payment here now, Black Girl Digital, I want you to see this. Okay, since you asked, I need you to look at column 3 and column 4. Column 3 and column 4. Column 3 is cumulative principal. This column adds up all the principal payments for you. Your principal payments are over here, but this column adds them up for you. The reason why I use brettwhistle.net for this, BRETTWHISSEL, brettwhistle.net. Okay. The reason why I do this is because when you get an amortization schedule from your bank, you only get 3 columns. You get principal, you get interest, and you get principal balance. You do not get a system that adds up for you cumulative principal and cumulative interest. You don't get that. My program actually does all of this work for you so that you can save the maximum amount of interest. Okay, so here's what this is saying. Here's what she's asking. Look at cumulative principal here, Black Girl Digital. Here's $105.51. You could pay that in 12 monthly installments. Okay, but if you did, it would cost you $4,989.99. If you made every single payment on time where you would pay $1,000 towards principal, the way the bank wanted you to, it would cost you nearly $5,000 in interest. But Black Girls Digital says, what if I just paid that early? What if I paid that on line 1? Well, you would be here in 1 month. Black Girl Digital. Your next mortgage payment will be on line 6. This would be February's new payment. And you would save exactly $3,994 in interest you never have to pay. That's what would happen if you put $1,000 on principal at the beginning of this loan. Folks, is this exciting to you? Is this exciting? Was it good to get the historical background on all of this? And listen, CEO Rock, can I apply this to my car payment? You better believe you can. Any loan that is charging you interest, you can cut your interest cost, not your interest rate, but your interest cost severely if you just know what to do and when. Okay, Black Girl Digital is dancing. She is on fire. All right, she's on fire. Oh, folks, I'm just getting warmed up. I'm just getting warmed up here because here's what's going on behind the scenes. when I need you to take a look at 1 year on this loan, $2,456 and a penny. Do you realize that if you pay what the bank wants you to, that, hold on for a second. Had to get another drink of water. That this $2,456 and a penny, here's my question. Do I have to pay this? This is all the principal that I would pay in 1 year. Do I have to pay it all in 12 monthly installments? Do I have to pay the $2,456 and a penny in 12 monthly installments? Yes or no? All right. Yes or no? I'm looking for it in the chat. Okay. While you're writing that, Deidre Hicks has a question. Are there any loan types that have clauses that forbid prepayments? Yes, there are. All right. Well, maybe not forbid, but they do charge you. We'll talk about that in a minute. Okay. We'll talk about that next. All right. So Deidre Hicks has asked a very, very good question. It's Brett Whistle, B-R-E-T. I'm putting it in the chat. B-R-E-T, Whistle, W-H-I-S-S-E-L. Okay. That's how you spell his name. You can go to brettwhistle.net and bring this up. Very valuable tool that we use here at the P.I.L.L Method to teach people. Okay. So are there any loan types that have clauses that forbid prepayments? So here's how these prepayment situations work. They're called prepayment penalties. Okay? They're called prepayment penalties. Oh, and I had another question that I missed. Can you pay more than $200 before the due date? Yes, you can. Yes, you can. But Justice, here's the thing. There is a point at which for each individual or church or business, if you have a loan, there's a point at which paying more, there's a point at which more is too much. You start to violate the law of diminished return. Hopefully we get a chance to talk about that. I have over 200 shows up on YouTube and we cover these things, and hopefully I can cover that today. Okay. All right. So hopefully I can cover that today. All right. I saw Miss Candace come in. All right. Out of the corner of my eye. All right. There she is. Miss Candace, how are you doing today?
Good morning. Just glad to be here.
Listen,
Can't wait to learn from you.
I'm glad you're here. I'm glad you're here. Uh-oh, I hit the wrong thing. Did I send her to the audience? I did. Somebody help me out. I need somebody to help me. Bring Candace back. Candace, I was trying to put him out. Listen, girl. Listen, I'm looking at 4 screens here. All right. Make moderator. There you go. So Candace, how have you been?
Wonderful. Just glad to be here, and I love learning and listening from you because you're the pro, the expert. So I can't wait to be here. I'm so glad. I'm so happy to be here. You just keep teaching, please.
Listen, I need you to go, when you have an opportunity, go back, watch us on YouTube. I had some historical data on how 30-year and 20-year loans came into existence and why. And so we showed all of that data. So folks, here's where we have it. Okay. Where we are right now is right here. Paying down $2,456 and a penny. I could do that over 12 monthly installments. It would cost $11,933.19 in interest. If you are a home buyer, if you are a real estate investor, I need to show you what is actually going on. Okay. So here is the amount of interest that I just paid if I did that. That's the amount of interest that I paid. So let me bring up my calculator, and I need to show you something. Okay. 11,000. We're going to clear this out. 11,933.19 plus the 2456.01 plus 2456.01 equals, come on, Don, click the right buttons. Okay. 11 933.19 plus 2456.01, right? That equals 14,398.20. All right. That's how much money you pay on this mortgage in the first year if you're a home buyer or real estate investor. Okay. $14,389.20. Okay. But the amount of interest that you paid is $11,933. So let's put the interest back in here. I want to show you how to do this math. Okay. 11,933.19 divided by the total amount that you paid on this loan, which is 14,389.20 equals here 82.829. That's 83%. 83% of your money that you paid out went to interest. That's why these loans are so attractive on the secondary market. Are you hearing me, ladies and gentlemen? Okay. When these loans are sold, when these loans are created, they're often sold on the secondary market. And this is the kind of money that these investors are making, where 83% of your money goes to interest. Let's break it down another way. Out of every dollar you put towards this mortgage, 83 cents of that dollar went to interest, and you're buying your property with 17 cents out of every dollar. Is that how you want to spend your money? Whether you're a real estate investor or a home buyer, is that how you want to spend your money? Where you're buying your equity at 17 cents a month, 17 cents for every dollar, and 83% of that money that your tenants gave you goes up in smoke. What if you were buying your gas that way? Where $45, I just spent $45 on gas. All right. What if every dollar I was putting towards to fill up my tank, every dollar, 17 cents out of every dollar went to put gas in my tank, and 83 cents out of every dollar went to taxes on the gas. Okay. So we're going to divide this by 17 cents. Look at that. It would cost $264 to fill up my gas tank if I bought gas like I buy my house. Does this make sense to you? If I wanted to buy $200 worth of groceries, and every dollar I put towards my groceries, 83 cents of it went to taxes, and only 17 cents went to fill up my basket, right? So I'm going to divide this by 17 cents. It would cost me $1,176.47 to buy $200 worth of groceries if I was charged like I buy my house. We got so used to buying houses like this, but we don't have to, because I showed at the beginning that these $200,000 cars that I showed have to be paid off in 8 years. They have to be. So what could happen with your car, with your house, if you start treating it like a car? So let's stop giving the bank 80% of our money. What would happen? So here's my question. If I'm supposed to pay this loan down by $2,456 and a penny, do I have to give it to them in 12 monthly installments? Everybody's saying no. Everybody is saying no. Okay. You don't have to give it to them in 12 monthly installments. If I had the 245601, could I pay it on line 1 as a principal prepayment? Could I prepay that amount? Answer is yes. Will I be paid down to line 12 in 1 month? The answer is also yes. Then my question would be, what happens to all the interest payments between line 2 and line 12? I get the same amount of equity. I get to the same place on this amortization chart. But it doesn't cost me $11,933.19 in interest to get here. It only cost me the $1,000 in interest on line 1. That is a $10,944.42 interest savings. Boom, right there. $10,900 savings. Ladies and gentlemen, do you see why you've never been taught how a loan actually works? Now, because of this, somebody asked about prepayment penalties. Let me cover that right quick. You see, when you have a loan, especially if you have a commercial loan, there could be some prepayment penalties on the loan. All right. In Canada, there are even prepayment penalties on residential property. In Bermuda, there are prepayment penalties on residential property. But here's what you need to know. Read it carefully, because this is basically what it says. If you prepay, there's going to be a penalty if you do. I want you to change the word penalty to the word cost. There is a prepayment cost to do this. So your question then has to be, how much does it cost me to prepay? How do you answer that question? By answering the question, how much do I benefit from prepaying? Here's a story. This is a true story. All right. I had a client in Canada. I'm showing them what happens when they prepay. But because nobody ever told them how much money they would save prepaying, they avoided prepaying their mortgage because there was a penalty for prepaying. So I showed them how they could prepay and save about $100,000 in interest. Okay, they're saving $100,000 in interest. And in Canada, on a lot of the websites, on the banking websites, they have a calculator so that you can calculate and figure out what your prepayment penalty would be. So with this particular client, guess what? When we did the calculation for them to save $100,000 in interest, the penalty or the cost was $1,200. You see, everybody is so focused on the penalty without knowing what the benefit would be. They're going to do all they can to avoid the penalty. Does it make sense to you to avoid $1,200 in penalties and then pay the bank $100,000 they don't need to avoid a $1,200 penalty? Do you see how we've been bamboozled, ladies and gentlemen? Do you see what's really going on here? You need to understand how to read this thing, because the historical data says that they want to make a lot of money off you when they don't have to. Here is what needs to happen. Have you ever heard that you should make a large down payment on your loan? Have you ever heard about making a large down payment on your loan? You know, I don't do this. So Laverne, before I get to that, do you have the videos in playlist format? Yes. If you click on videos, right? When you go to YouTube and you click on the live videos, they have them all in a playlist format. It looks like this. If you're on screen, I'm going to go to my YouTube channel, pull that up. Okay. And what we're looking at, if I click on lives, okay. If I click on live here, it's in playlist format. Look at this. Over 200 shows. Data, more information. There's so much information. We've been over almost 2 years worth of shows here. Okay. So just click on that and it puts it in that format for you. Okay. So back to here. So now let's talk about what happens when you want to do a down payment. Never, ever put a large down payment on a loan, because listen, what if I had this $200,000 mortgage, right? Okay, $200,000 mortgage, and I wanted to put $50,000 down. Okay, I'm going to duplicate the tab. So here I'm going to put $150,000 mortgage in. Okay, $150,000. Here's my new payment. Okay, $150,000. My payment is $899.33 because I put 50 grand down. And my total interest payment, if I keep it for 30 years, it's going to be $173,000 instead of the $230,000 that they want from me. $231,000 versus $173,000. Plus, my payment is like $300 cheaper per month. Why wouldn't I do that if I had an extra 50 grand? Here's why. Because if I get the $200,000 loan, do I still have my 50 grand in my pocket? Yes or no? If I get the $200,000 loan, do I still have the 50 grand in my pocket? Somebody put in yes or no in the chat so I can see it. Do I still have my 50 grand? Yes or no? All right. There you go. I still have it. Now, if I wanted to, could I prepay the 50 grand after I made my first payment? Could I prepay the 50 grand and put it on this loan? Tammy Boy says, yes, you can. So I'm going to prepay the 50 grand on the $200,000 loan. I need you to see what happens. We're going to go to cumulative principal. We're going to look at we're going to scroll down to 50. No, Lord have mercy. I'm going to listen. Do you see here payment 144? That's 12 years. 12 years. And we're only at 41,000. We're down to 50 grand. 13. I knocked off 13 and a half years off this loan by putting the 50 grand as a prepayment instead of a down payment. And look over here to the side. I still have a $150,000 loan. But I'm not starting out on payment number 1 on a 30-year loan. I'm starting out on payment 164 on my 30-year loan by making a prepayment to principal instead of a down payment on a loan. Never, ever, ever put a larger than you need to down payment on a loan. Ever. It's a total waste of money. See, all of this stuff that we've been taught is backwards. Listen, I've got, it's 10:14, and some of you have been waiting patiently. Some of you may want to know how, I'm going to show you one other example, but some of you may want to know how can you know some of this on your own? Can you get some private coaching? Can you get our opportunity cost calculator that you're going to be learning about? How can you pay off all of your debt in about 7 years? Not just the mortgage, but your mortgage, your student loans, your credit cards, everything in about 7 years. All right. I'm going to give you what's called a savings and earnings report. And you can get the savings and earnings report for free. You can know the month, day, and year you can be debt free. You can click on the link at the top of the page. Click on the link at the top of the page, and you'll see a button that says Get a Savings and Earnings Report. Follow all the instructions. And when you follow the instructions, you will be led to a financial form. Now, the most important instruction is when you put your cell phone number in so that we can verify it and give you a code to get in. Make sure there are no spaces when you're putting in your cell phone number. Absolutely no spaces, no dots, no dashes, no nothing. Make sure your phone number is right next to the one that we provided. Okay? Make sure there's no spaces. When you put it in, and then you go to, and then follow the rest of the directions, put in your financial data that we asked for on all of your loans. Put everything in. And then someone from my staff will call you and verify the information and then set up for you a consultation. Our consultations are only $150. $150 for the consultation. And in that consultation, you must receive at least $150 worth of benefit. Because if you don't, You just tell me before we get off the phone, and I click the button and send it right back to you. Everything we do is guaranteed. Every single thing we do is guaranteed here. We'll send it back to you if you don't think the information you received was worth it. Bottom line. All right. So that's that. So then you can know the month, day, and year you're going to be debt free and how much interest you're going to save. And then if you want to become our client, we'll show you how you can become a client for a lifetime and use part of the monies that you're saving on interest to pay for your lifetime program. What? Yes, I'm actually going to use the money that the bank thought they were going to get. I'm going to use a small portion of that to pay for your lifetime program, and the rest of the money is yours. And that's just on the first mortgage. When you put the second or third or fourth one in, it doesn't cost you any more, but your savings are going to continue. Oh my gosh. I have people paying off their fourth and fifth mortgage, and they bought the program years ago and haven't paid a dime since. So that's kind of what's going on there, folks. If you want to know, that's how you know. Also, if you got this information and you thought it was valuable, I need your help. Using the same ice10k.com, I need your help. Click on Become an Affiliate. And as you become an affiliate and you refer people to us, you don't have to sell a thing. You don't have to sell anything. Just point them towards our YouTube channel. Follow up with them in a couple of days. All right. No more than 48 hours. And then because you signed up as an affiliate, you can use the same card to send us a referral. Now, the people that you need to send to us have to have at least $100,000 in debt and a mortgage. Okay. Any combination, $100,000 in debt and a mortgage, any combination, but it has to be at least $100,000. You send that to us, and when they become a client, I'll pay you $300. And it's a graduated scale. If anywhere from one person to five, you can earn anywhere from $300 to $3,000 a month just by referring people to us, and you're not selling a thing. That is what we do. I need your help. So thank you very much for that. All right, folks, let's get back to this thing. I want to show you a couple of other things, all right, about in the last few minutes, I want to show you something that everybody is doing. Do you realize because of I got people who want to come to the stage. All right, let me see if I can bring you up. So if you have a question to ask, go ahead, raise your hand. Let's see. All right, I'm seeing more hands. All right, invite to speak. All right, Maria. All right, we're going to invite you up. All right. So okay. All right. Anybody who has a question. So Maria, do you have a question for me?
Yes. My mom, she lives in an apartment. My question is how does she start to get a house of her own?
Oh, wow. That is so easy. Okay. You want to get a realtor, find a realtor. Okay. And work with that realtor, and that realtor will help you to get a pre-approval, from the bank. Once you get that pre-approval, then the realtor will help you to start shopping for a house. How's that sound?
That sounds good because, she's been living in an apartment for so long and, she deserves to get a house.
Yes. Okay. And not only does she deserve to get a house, she deserves to pay it off in 7 or 8 years and not 30 years to never. What do you think about that?
Of course.
Of course. Thank you very much for coming to the stage. Do you have any other questions for me?
How much of a credit do you need to get a house?
Well, that's why you need to work with your professionals. They're going to help you to work on that. They're going to help you to determine that. There are a lot of different issues out there. Okay. It's not a one size fits all. So do not discount yourself. Do not disqualify yourself when you're thinking about moving from being a renter to being a home buyer. Okay. Talk with a professional. Their job They get commission on selling houses and selling mortgages. They're going to try to put you in the best position possible to do both. Okay?
Okay, thank you.
You're so welcome. You're so welcome. I see Katori. We pronounce your name correctly? Katori?
Can you hear me?
Yes, I can.
Oh, hi. Yes. Question is, and you may have covered this earlier.
Mm-hmm.
I came into the room late,
Yes.
but as far as discretionary income that a person would need
Mm-hmm.
in order to make this work for them, I just think about how, and I'm just kind of, this kind of goes to the left a little bit.
Okay.
But so many people are in a position they want to buy a house.
Mm-hmm.
And the only way that they can buy the house is, and they're just barely meeting those DTIs or whatever they need
Mm-hmm.
to meet, right?
Debt to income ratio.
So the extra money, correct. The extra money that it requires in order to really make this work and to really, see the difference that, you demonstrated here. And I know this is all relative, but what would you say would be the extra money that they would need to make this work?
That is a good question. Okay, let me show you how easy this is. All right, I need you to imagine just for a second, okay, how much money you're actually making in a month. Okay, and here's what most people don't do. When I ask people, do you know most of the people I talk to, they have no idea how much they're making each month. They don't know. They never stop to count it. So start by knowing how much you're making each month and then list all of your monthly expenses. List them all. Your food, your electricity, your rent, or your mortgage payment, whatever it is. List it all. How much you pay for your electricity, how much you're paying for your TV, your streaming services, whatever it is. When you list it, you will actually see that you have money left over. It is because we don't list it, we don't track it, we have no idea. So people ask me all the time, it says, Don, what if I don't have any money left over? I said, that's impossible. This is, what do you mean? So if you're making $5,000 a month, I don't know anybody who spends exactly $5,000 a month on their bills. Does that make sense to you? That I would spend exactly $5,000 a month on my bill and I don't have any money left?
Right.
You see, what happens is they keep spending past the bills because they're not tracking. So it feels like paycheck to paycheck. It feels like I have no money. I had a client come to me and says they were filling out the information and they asked me the same thing. What if I don't have any money left over? So I asked them these questions. Do you have to use your credit cards to pay your bills? They said no. Do you have enough money every month to pay all of your bills? Answer was yes. Do you ever have to dip into your savings to help you to pay bills? The answer was no, which means that means they have money available. They have money to pay the bills. So we gave them what's called a budget sheet. Gave them a budget sheet and said, fill this out. It told them, put in your food, put in how much money you're making, put in your electricity, insurance that you pay for, put in all of your bills. And it took her some time to get that back to us. And I asked, when she finally got it back to us, I said, why did it take you so long? She says, I had to fill it out 3 separate times. I said, why is that? She said, because I kept coming up with the fact that I had $2,000 left over after all my bills are paid. Come on,
So
Miss Katori.
It forced her to look for the leaks where she's leaking money and spending maybe frivolously. But so this definitely takes a level of discipline as well as organization to see where you are spending money, where you don't need to spend money. But it still goes back to, and some people are actually disciplined and they are actually budgeting and they just don't have the extra. So do you help people find that extra?
Oh,
It
definitely.
sounds like you do because of what you just said. And here's just a follow-up question.
Mm-hmm.
What happens? I'm sorry.
Go ahead.
Did you say something?
Mm-mm.
I thought you said something.
Nope.
Okay. So my follow-up question is, what happens when people say, oh, well, I don't want to pay off my mortgage because this helps me with the tax write-off. And obviously I can see where you save so much more by doing it this way.
Mm-hmm.
But there are so many people out there that have that question. So if I became an affiliate,
Mm-hmm.
and someone asked me that question, or if someone makes that comment, what would you say is the quickest way to come back?
Oh, well, listen, that's very easy, because even though you are prepaying your mortgage and saving money, you still have to make 12 mortgage payments a year. Okay? Because you're contracted to. We don't cut out how many mortgage payments you make in a year. We just cut down the number of years you need to make mortgage payments. Does that make sense?
Yeah.
So if you're making 12 mortgage payments in a year, you still have to pay interest.
Mm-hmm.
If you qualify, you're going to get the break on your taxes for the interest paid for that year.
Right.
So
Exactly.
instead of getting it for 30 years, you're only going to get it for 7.
Right. So they use it as a tax write-off, but they see it being more beneficial by paying it, off over the 30 years. But now they've changed the tax laws to where you can't even do that anyway. So after so much depreciation, you can't even write it off.
Hold on for a second, Katara. Will you go? I need to get out of here. All right, for the folks online, I'm putting right now our program on the screen, and here's what it looks like. This is the program that does all of the work right here. All right. So I'm letting everybody go online right now, but I wanted you to see, here is the program that does all of the math that guides you, like Financial GPS. Let's hear from Dr. Eric Thomas, and we're going to say goodbye to everybody online, but I'm going to come back here to everybody on Clubhouse. See you guys.
Thanks.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.